Look, it's moving. It's alive. It's alive. It's alive. It's moving. It's alive. Oh, it's alive. It's alive. It's alive. It's alive. Oh, in the name of God. Now I know what it feels like to be God.
Now, some experiments may appear successful at first, but down the road they prove to be absolutely disastrous. In fact, in recent years, central banks have been playing Dr. Frankenstein with the global economy. The objective at first was to restore life to the economy and financial markets during and immediately after the financial crisis. The objective since then has been to keep it alive. The question becomes, will it all prove disastrous in the end and even possibly spawn a worse financial crisis than the last? It's time once again to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategies strives to set new standards and bring institutional style investing to your portfolio. I'm David Scranton. As you probably recall, Dr. Frankenstein brought his creature to life with artificial experimental methods. That's a fitting metaphor for what the Federal Reserve and other central banks have been trying to do with the global economy. Loose monetary policy and the liberal use of quantitative easing were intended initially to restore life to the economy, but not really to keep it alive long term. In fact, it was supposed to be able to regain its own natural life. But many economic experts agree that really hasn't happened yet, at least not to the extent the Federal Reserve and other central banks would like, and that ultimately there could be dire consequences to all the unchecked experimentation that these central banks have been allowed to conduct over the last several years. So what do you need to know about how to keep your money safe? Well, joining us to help answer that question, many others, are journalist Nomi Prinz, author of Collusion, How Central Bankers Rigged the World, and economics professor Lawrence Ball, author of The Fed and Lehman Brothers, Setting the Record Straight on Financial Disaster. But first, let's talk about what led to all this experimentation at the beginning, and whether the same situation could repeat itself. Now, as everyone probably knows, the age of economic uncertainty in which we find ourselves can be traced back to the financial crisis. In many ways, it was an unprecedented event. So you can make a case that the efforts to address it needed to be unprecedented as well, and they were. As we discussed on last week's show, though, the collapse of Lehman Brothers in September of 2008 and the chain reaction that followed prompted swift reaction from the Federal Reserve. Their first order of business was to bail out most of the major banks that were deemed to be, quote, too big to fail, meaning they were considered so powerful that their failure might have resulted in a complete collapse of the global economy and the monetary system. Through the Troubled Asset Relief Program, or what's been known as TARP, over $700 billion of taxpayer money was used to prevent the big banks from failing. Now, not everyone approved of that move, arguing that the banks should be allowed to fail despite the repercussions, and that rescuing them was setting a bad precedent. One critic of the move was former Fed Chairman Alan Greenspan. He and others argued that there's a moral hazard in designating a financial institution as too big to fail. Why? Because it amounts to giving them preferential treatment. That increases the risk that the bank might deliberately engage in terms of risky investment practices. Why? Because they know that they have protection under a too big to fail umbrella. Bailing out the banks was, as some argued, essentially the Federal Reserve handing the big banks a license to go out and engage in the same kinds of risky behaviors that led to the financial crisis in the first place. But if that's true, the question becomes, have they been using this license? And if so, could the Fed's first experimental fix after the financial crisis actually trigger a repeat? Well, let's face it, anything's possible. But there are some differences in both the regulatory environment and the housing market today that make an exact repeat of the financial crisis somewhat less likely. As you probably know, another response to the financial crisis was the passage of the Dodd-Frank Wall Street Reform and Consumer Protection Act back in 2010. Although portions of Dodd-Frank are now being rolled back through the Trump administration, it still remains one important change intended to help make sure the lending abuses that led to the crisis cannot happen again. And there are others. While it's true that much of the financial machinery that produced mortgage-backed securities and financial tools like them, yes, is still in place, it's also true that there are some differences between the housing market now versus 12 years ago that make the abuse of those somewhat less likely. For example, back then, there was simply an oversupply of single-family homes. In order to fill it, lenders extended credit to people who shouldn't have gotten it in the first place. They did this by artificially suppressing interest rates or principal payments for the first few years of the loan, and then resetting them at a higher rate after those first few years. Home prices soared as demand was artificially inflated by Wall Street, where traders and brokers realized that they could get rich just from the transaction fees alone on these mortgages, regardless of whether or not mortgage payments were actually ever made. But then in 2007, when the artificially repressed interest rates and principal payments finally did reset, defaults on the loans started skyrocketing. The mortgage-backed securities backing them actually failed, and the whole system began to collapse. Now, one key difference today is that subprime mortgage loans, as they've become known as, with adjustable rates, aren't being written at nearly the same volume as before. Now, this has nothing to do with new regulations, though. It's simply because the housing market is, in many ways, the opposite of what it was back in the mid-2000s. Instead of a housing oversupply that needs to be filled, right now there's actually a housing shortage that's creating an affordability crisis. People need a lot of cash to put down on a home or great credit to be able to qualify for a mortgage. What's more, nearly 90% of mortgage-backed securities today are produced by Freddie Mac, Fannie Mae, and Ginnie Mae, which, as you may recall, were taken over by the government in another move resulting from the financial crisis. They now all have strict credit guidelines for the mortgages that they package into mortgage-backed securities. At the same time, a lot of other mortgage lenders don't hold the loans they write, but instead sell them subsequently to Fannie Mae or Freddie Mac to redeploy them into new loans. And they can't sell to Fannie or Freddie if they don't conform to their strict new rules, which basically forces all banks and mortgage lenders into better lending practices. So, does all this mean that banks and mortgage loans couldn't be the cause of the next major stock market collapse and another financial crisis? Well, no, I'm not going to go that far. Although I am cautiously optimistic for the reasons I just shared. On the other hand, one could argue that the Fed's unprecedented response to the financial crisis has dramatically increased the odds that something else could trigger a new crisis. We'll talk about that more in just a moment. Right now, let's welcome our first guest, Nomi Prinz. Nomi Prinz is a renowned journalist, former international investment banker, author, and speaker. In her career, she's worked as a managing director at Goldman Sachs, a senior manager at Bear Stearns, and a senior strategist at Lehman Brothers, and an analyst at Chase Manhattan. Her articles have appeared in the New York Times, Forbes, Fortune, and other major publications. And her new book is called, now get this, a girl after my own heart, Collusion: How Central Bankers Rigged the World. Nomi, welcome to our show.
Thank you so very much.
So tell us, give us the Cliff Notes version to start at least, to wet our whistle, if you will, as to how have central bankers rigged the world?
Well, the Cliff Note of it is that in the past 10 years, since the financial crisis of 2008, at the Fed's coercion or collusion, as I call my book, the major developed country central banks, the G7 central banks, have collectively created over $22 trillion worth of money with which they've bought bonds, stocks, and other things from the private banking system in order to liquefy them, to keep them whole, and effectively have subsidized them by that amount in the process, along with having a monetary policy of 0% to -% interest rates on average prevailing across the world since the financial crisis.
So your biggest concern is that essentially they've created a bigger demand, market demand for certain securities, and perhaps a tangential comment on that would be they push people up the risk curve, and now the stock market's created a bit of a balloon, or some would say a bubble. Is that really a big part of your hypothesis per se?
That's the main hypothesis related to monetary policies. If you inject so much money from an external source into the system, it creates artificial demand, as you say, and also just artificial capital that then gets diffused throughout the world in financial assets, but it doesn't necessarily help the real economy which would in an alternate universe be bolstering stocks and sustaining itself from a growth perspective. So it's created a sort of artificial reality in which we've all had to succumb, which is good for now, but because of its artificiality, creates a lot of risk upon us going into the future should it change in any meaningful manner.
Now, many would argue that if you could drive up the stock market and you could drive up people's assets in their portfolios and their 401ks, it has a bit of a placebo effect, because now maybe if they feel a little bit more affluent, maybe they'd go out and spend a little bit more money, and maybe that spending would actually stimulate the economy. So I know central bankers might argue that indirectly that helps create demand for goods and services. Of course, you and I would probably agree that's kind of a lukewarm argument at best. But my question is, do you think now our own Federal Reserve, for example, to use ours, do you think we've gotten away from our original mandate, where now they're more concerned about keeping Wall Street happy than they are doing really what the central bank was initially designed to do?
Well, I would argue that the central bank was initially designed to keep Wall Street happy, or at least to keep liquidity in the system in the event of an emergency for private banks. It was also, though, sold to do its day job, which is ultimately to maintain a level of rates, a sort of cost of money such that unemployment was limited and inflation was at a healthy rate, and in that way could kind of create a sustainable economy. Their job was never, though, to really jurisdict over the economy. But by diffusing so much money into the system, that placebo effect has also incurred a lot of debt creation at the consumer level in order to buy those things. They feel good. The stock market's up. It looks like their portfolios are high. Why not borrow some more? Corporations are doing the same thing, both to buy their own stock as well as to increase their debt levels. Companies in countries around the world are doing that, and countries are doing that themselves. So emerging market countries to developed countries have much higher debt to real production, real GDP levels than they had before the crisis and before this artificial Fed policy and central bank policy globally.
Yeah, it's interesting too. You mentioned the interest rates. The short-term interest rates, after the tech bubble had burst, they'd gotten down around 2%. Of course, this last time they got between 0 and 0.25, as you're well aware. And then when that wasn't enough to stimulate the economy, that's when all the quantitative easing took over. So I want to talk to you a bit more. We need to take a commercial break, so stay with us, please, Nomi. And you stay with us, too. We have much more from Nomi on the income generation. We'll be right back. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 core values to help protect your money in good times and bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Available now.
It's hard to believe, but it was 10 years ago that the financial crisis really took hold and the Federal Reserve began rewriting its playbook. So much has changed since then. It's almost hard to remember that there was a time where financial markets were actually driven naturally by economic fundamentals rather than unnaturally by the lingering effects of economic stimulus. It actually all began months before the collapse of Lehman Brothers in September 2008. In January of 2008, fearing the possibility of a recession based on early warnings about the housing market and steep market declines abroad, then Fed Chairman Ben Bernanke called an emergency meeting. At that meeting, the Federal Reserve agreed to lower short-term interest rates by 0.75%, which was actually triple the adjustment they might make normally. And it was even more unusual considering this wasn't done at a regularly scheduled meeting. The last rate cut that big was done back in 1982. And the last cut of any kind outside of a regular meeting was in 2011, right after 9/11. In other words, it was evident even before the housing market collapsed and the big banks failed that something major and perhaps even unprecedented was about to occur. Another sign, of course, was the stock market which had lost 10% of its value in the first 3 weeks of 2008. All through the fall of 2007, there had been growing signs of trouble in the housing market and a credit crunch at major financial institutions. By January of 2008, Bank of America announced it was buying the failing subprime mortgage company called Countrywide Financial Group. And this was only a week after Merrill Lynch and Citigroup together had taken $35 billion in write-downs. The Federal Reserve had already cut its GDP forecast for 2008 to a paltry 1%. And although they weren't yet predicting a recession, they knew that cutting rates so drastically in an emergency meeting like this might be taken as a sign by Wall Street that they did foresee a recession and send the markets tumbling even further. And of course, that's exactly what happened. And in some ways, it can be seen now as an omen of things to come. This complex, you might call it codependent relationship that's emerged between the Federal Reserve and Wall Street is just one problematic side effect that's resulted from this era of quantitative easing and economic experimentation. That emergency meeting in January of 2008 might also be seen as an early sign that the Fed was going to be willing to play by new rules in response to the next financial crisis, to focus more on artificial strategies aimed at quick fixes than on long-term approaches that allowed the markets to function and fluctuate more naturally. As Fed historian Peter Conti Brown put it, I think this, meaning January 2008 meeting, is an important canary in the coal mine to show exactly how the Fed is going to approach its own conception of its emergency authority. We see that the Bernanke Fed is truly going to do whatever it takes in order to sustain its economic mission, end quote. Now, following that unscheduled rate cut, the Fed cut an additional 0.5% at its next regularly scheduled meeting a few weeks later. In the coming months, it would finance J.P. Morgan Chase's purchase of Bear Stearns and lend billions of dollars to insurance conglomerate AIG. It would also cut the federal funds rate to near zero and start multiple rounds of quantitative easing, buying trillions of dollars of mortgage-backed securities and treasuries. To a large extent, these actions were completely unprecedented, and because of that, yes, experimental. Their long-term consequences have yet to be determined. Now, as you regular viewers know, I've always likened the Fed's short-sighted use of economic stimulus to that of an athlete using steroids. Yes, it may temporarily enhance performance, but it's also potentially addictive and has long-term negative consequences for that athlete's health. We already know quantitative easing became addictive, particularly with the stock market. As for those long-term negative consequences, we'll talk about that more with our guest, Nomi Prince. And we are back with Nomi Prince, author of Collusion: How Central Bankers Rigged the World. So, Nomi, you used the word rigged, so I'm going to put you on the spot if I can for just a moment. There are some people out there that many would say are conspiracy theorists, if you will, that look at how the central bank was formed by some of the countries, our central bank at least, by some of the country's wealthiest families that are out there. And some folks argue that those people still have a lot of control over the central bank, and essentially they even control governmental policy in many ways. Are you one of the people that buy into that at all, or think that's at least partially true? Tell us.
Well, I don't really buy into the term conspiracy, because to me that means something sort of dark and deep that we can't find public information to sustain. So in my work, both in Collusion and the last book I wrote, All the President's Bankers,
Yep.
I actually look at real publicly available information and have just way too many footnotes in my books. Every time I hand in a book, my publisher's like, cut out the real stuff because your footnotes are just too long. That relate to real information in library archives from the presidency to administrations to Congress to Library of Congress to periodicals at the time to so forth. And so one of the things that I had looked at with respect to what you just mentioned, sort of Wall Street controlling and all of that with respect to the development of the Federal Reserve is the reality. The reality is that the people that met and that ultimately provided the initial documentation that became the Federal Reserve Act of 1933 consisted of a senator, Nelson Aldrich from Rhode Island, who also happened to run the Senate Banking Committee at the time, and 5 other people, one of whom was the assistant treasurer of the United States at the time, and the other 4 were bankers. And those bankers happened to be involved in both being wealthy as well as some of the bigger family banks at the time in the nation, where they met, which was Jekyll Island. This is documented. I went there and I saw the books, as many other people have written books on that. I saw the ledgers of who came there and who left, and I have them in a video. That's a whole other thing. But J.P. Morgan, who was the main banker at the time that they met.
It sounds like you believe that there's some truth to that. You might not use the word conspiracy.
Right.
It just, it's not being covered up. It's just that a lot of people don't know about it just because they're not informed to that level. That's all.
Well, that's right. So yes, so conspiracy would be more of a cover. This is actually what occurred, and as a result, over history, these bankers have had not just a vested interest in how the Fed has behaved and how central banks have behaved, and how governments have related to those central banks, but also a vested interest in forging all the laws and the restrictions or the regulations by which they are supposed to operate to allow them to have more risk, because there is a Federal Reserve that is there to protect them and subsidize them in the event of an emergency or crisis, which we recently saw that very big one 10 years ago.
So in a word, it sounds like the Federal Reserve is kind of sort of getting a little bit too big for their britches, you might say, overstepping their bounds just a little bit. But to you, it's really no surprise. It's in a nutshell, is that pretty much it?
It's not a surprise that they've acted to save the banks and to subsidize the banks after the financial crisis. It's not a surprise that it was done on a global basis this time relative to other times, because banks are so interdependent globally. Just exacting a U.S. Solution just by the Fed and not getting the ECB and Bank of Japan involved would have not been enough.
And Nomi, for this block, we need to leave it there just because we do need to take a commercial break. I apologize. But stay with us. We'll be back for one more block. And you stay with us too. We come back, we're going to ask Nomi Prinz some questions about how she thinks this applies to you, members of the income generation. We'll be right back. If you're not using someone who's well-trained in fixed income and you're born before 1966, it may just be time for you to break up with that advisor and move on. I would suggest someone who will care for you through these important years of your life. If you need help finding someone, call or write us. I'd also like to remind you of the special report entitled The Income Generation. This is available free to you, our loyal viewers, online. If you haven't downloaded your report, pick it up after the show. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. We'll see you all next Sunday. Now, while it was former Fed Chairman Ben Bernanke who kicked off the era of economic experimentation with his decisions 10 years ago, it was ultimately his successor, Janet Yellen, who really took it to the next level. Under Chairman Yellen, the Fed approved 2 additional rounds of quantitative easing after the first one didn't have the desired effect of combating recession after the financial crisis. And ultimately, there were 4 rounds of easing when you include Operation Twist, which Ben Bernanke launched in 2011. The immediate effects of all that stimulus are still being debated. But if the strategy had worked as well as the Fed Reserve had hoped in the first place, obviously it wouldn't have been necessary to keep going on for 4 rounds over 6 years. The recession that could not be stopped after the financial crisis became known as the Great Recession, one of the biggest and most prolonged economic downturns in America since the Great Depression. But while artificial stimulus was slow to create an economic recovery, it did create an asset recovery. in part because it forced everyday investors up the risk curve and into the stock market, into riskier investments, by making other interest-based investments appear to be less attractive in comparison. For that and several other reasons, the stock market became dependent upon artificial stimulus in much the same way that an athlete can become dependent, or somewhat addicted, if you will, on steroids to maintain a certain performance level. And, as I've discussed on previous shows, even though the Fed stopped its bond buying program over 3 years ago, the stock market has continued to be driven more by artificial influences than by economic fundamentals. Right after they stopped this quantitative easing here, it was the global impact of quantitative easing programs abroad as many European countries picked up our own bad habits. And more recently, of course, it was the election of President Trump and his promise to deliver a consistent 4% GDP growth. With the president's election, the leadership of the Fed changed again. Jerome Powell took over as Federal Reserve Chairman earlier this year, inheriting the job of, quote, normalizing monetary policy. Once again, after a decade of experimentation. Part of that process has involved the unwinding of quantitative easing, which is an attempt to normalize the Fed's balance sheet by selling back those trillions of dollars of U.S. Treasuries. Just as buying the bonds was an attempt to put downward pressure on long-term interest rates, selling them back to the public is an effort to force long-term interest rates back up again. But as I've explained in past shows, the Federal Reserve needs long-term rates to rise so they have room to continue raising short-term rates without harming lenders by doing this thing which we refer to as flattening the yield curve. As I've also explained, the strategy really hasn't been working very well. And I believe that long-term rates will continue hitting a strong resistance level, a strong glass ceiling, right around that 3% level or so, give or take just a little bit. As an article in Market Watch put it recently, the Fed right now is walking a tightrope as it aims to normalize interest rate policy without suffocating economic growth or fostering bubbles or another recession. And as Wall Street is watching this tightrope walk very carefully and reacting to every momentary loss of balance. Why? Because even if the markets and the regulatory environment have changed, if they've changed enough since 2008 to prevent a housing bubble from causing the next financial crisis, the Federal Reserve's policies and actions in response to that crisis may just have created a host of new potential causes. And that's truer today, and it's never been truer than today, with so many unknowns complicating the Fed's efforts to normalize policy. From fears of a trade war to the strengthening of the dollar and ballooning federal deficit. In fact, some experts see the next crisis as being absolutely inevitable and see the stock market's record volatility since February as an early warning sign. In fact, as veteran investor Mark Mobius told Bloomberg recently, quote, "There's no question we'll see a financial crisis sooner or later because we must remember we're coming off from a period of cheap money. There's going to be a real squeeze for many companies that depended upon cheap money to keep on going." We're back with Nomi Prins, author of the book Collusion: How Central Bankers Rigged the World. Nomi, I'm sorry I cut you right off there. We had to take a commercial break. You'd said it was expected in two ways, but then I think you were about to say, but there was one component of it or so that was unexpected. So what was that unexpected component?
It was the magnitude. The fact that the Fed has created $4.5 trillion worth of money to sort of throw into quantitative easing. The European Central Bank, the Bank of Japan, both over $5 trillion. The Bank of England close to $1 trillion. That the magnitude by which they acted to produce new money, electronically created money to subsidize the system was high.
So do you feel like I do that maybe the initial TARP program was actually essential to keep the financial system from freezing up, but then when they came out with QE2, Operation Twist, QE3, that those other ones were perhaps excessive? That's kind of my philosophy. Are you kind of sort of in agreement with that?
They've been excessive. I'm not necessarily, they could have done other things to keep the system from falling, but certainly that money should have been enough. It was a lot, but there have been multiple trillions of dollars more since then, and that indicates the system simply isn't healthy, and it is being subsidized, as are the markets, by this external force of central banks. Mm-hmm.
So this creates a couple potential bubbles, really. We talked about the stock market, people getting pushed up the risk curve. That's a potential bubble. Some would argue that there's risk in the bond market. I tend not to be as concerned about that because that's the area in which we work, and I'm very knowledgeable in that area. But there's some risk there because interest rates, eventually could come back up a little bit. But the other thing is really the debt bubble that you mentioned. So I guess I'm looking at it as the biggest short-term bubble we can worry about for our investors, for our income generation members, the viewers of our show, is the stock market bubble. That's really the first thing. But then longer term, there's that debt bubble. So first of all, do you agree with that? And if you do, how can people protect themselves?
I think what's happening now after the 10 years of this process is that, yes, there are bubbles in all of those asset areas. And the way to protect going forward, because there is a little bit of rate increase from the standpoint of the U.S., I don't think they're going to go, hugely hiking rates anytime soon,
Right.
but there's been incremental changes. But what that means is it's more important to look at sectors when you invest in simply overall market levels, because whereas all of this money has gone into higher risk assets, gone into the liquid stock market where it can move more quickly and become higher faster, right now we're seeing a little bit of pushback, a little bit of the realities of companies or people who are sort of at the ends of their financial sort of liquidity themselves, not being able to put as much in besides buybacks. And so it's kind of important to now look at all the things that are coming into the system to amplify QE, which are buybacks and which should be sectors and companies that aren't leveraged, that simply haven't taken on as much debt as other companies. Because when or if rates rise, they're going to have, the ones with the most leverage, the most problems. So what happens now in terms of how you allocate is looking at areas where there is cash, where there are buyback potentials. I have issues with buybacks, but they do elevate share prices for certain companies, and low leverage conditions that are also not impacted by some of the geopolitics we have to be looking at, like right now, like trade wars and so forth. So there are sectors now that people can look at. Some of the healthcare area, some of the food area that's not agricultural, like frozen foods. Banks themselves are still doing well, even artificially, on the back of continued easing, and they will be protected as long as possible by the Fed and so forth. So there are just areas that people have to pick more than simply overall levels.
Bottom line is Mohammed Al-Arian, our guest last week, had said the days of mutual funds and ETFs are pretty much over, and it's more about individual security selection and being conservative. So
That's right.
I agree completely. Listen, it's been my pleasure having you on the show. Thank you so very much. And you stick around with us. We'll be right back with more right here on The Income Generation and our next guest, Lawrence Ball. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. We'll see you all next Sunday.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Available now.
I mentioned in the last segment of the show that I expect long-term interest rates to continue hitting quite a strong resistance level at the level just about 3% or maybe slightly above or slightly below. Now, if you're a regular viewer, you know that I've been making this point ever since early February, when fears about rising long-term interest rates and inflation were first blamed for the return of this incredible market volatility that we've been seeing over the last half year or so, after having record calm all through 2017 in the markets. And so far, that forecast has proven accurate. Although the yield on the 10-year Treasury rate briefly topped 3% in both April and May, it hasn't done so since and hasn't risen past 2.9% in nearly a month. As I explained when first making this forecast, there are several forces working against the Fed's experts to push long-term rates upward with this unwinding of quantitative easing. Selling back all those bonds is supposed to flood the market and drive down the demand for bonds, therefore pushing down prices and driving up yields and interest rates. The problem is that demand has remained, and I believe will remain strong for a few reasons. One is that foreign investors will continue to turn to our bonds as their only option for any kind of return. Why? Because quantitative easing efforts abroad are keeping their interest rates still artificially suppressed. Another is the flight to quality toward bonds among big investors. With historic levels of volatility and so many uncertainties plaguing the stock market, they will continue to invest in bonds as a hedge against the possibility of another major stock market collapse. The third reason is that I believe baby boomers, the country's largest and most financially influential demographic, will continue to favor bonds and bond-like instruments as they increasingly shift their focus from growth to income and make asset protection their top priority. In fact, the degree of volatility we've seen and may continue to see in the stock market as QE and unwinding efforts continue can actually be good for income-based investors. As interest rates fluctuate slightly above and below this 3% mark or so, it gives experienced portfolio managers the opportunity to lock in bonds at better rates on behalf of their clients. The result is more income, and with an income-based financial strategy. Protection and income, in that case, is what it's all about. Lawrence Ball is a professor of economics at Johns Hopkins University and an associate at the National Bureau of Economic Research. He's been a visiting scholar at a number of central banks, including the Federal Reserve, the Bank of Japan, the Bank of England, and the Reserve Bank of New Zealand. He has a book out entitled The Fed and Lehman Brothers, Setting the Record Straight on a Financial Disaster. Lawrence, welcome to the show. It's great to have you.
Thank you. I'm glad to be here.
So, the bankruptcy of Lehman Brothers, now about to go on its 10th year anniversary.
Yes.
Could that have been avoided? Should they have bailed out Lehman Brothers? Give us your thoughts on that. And essentially, a little bit of a Cliff Notes version of what you have here in your book.
Yes, it could have been avoided, and yes, they should have bailed out Lehman, although I don't really like the word bailout. It's a little pejorative. I would say they should have given a temporary emergency loan to keep Lehman going to try to work out its problems. But the basic point of the book is that Federal Reserve officials, ever since the bankruptcy, have said their hands were tied because they didn't have the legal authority to rescue Lehman because Lehman did not have enough collateral for the loan it needed, which is a requirement under the law. And rather long story short, what my book establishes is that that's simply not true, that Lehman did have enough collateral for the loan that it needed to keep operating. So the Fed could have kept Lehman in business at least for a while, and that would have prevented a lot of the chaos associated with its failure. And probably the whole financial crisis and Great Recession would not have been as bad.
Well, of course, the old saying, hindsight is 20/20, so I'm going to put you on the spot now, Lawrence. To be honest with our viewers appreciate honesty. Pulling the clock back 10 years, at that point, were you still a fan at that point of bailing out Lehman Brothers? Or have you come across with hindsight after the fact saying, we really should have done this?
Well, I am certainly using hindsight. I think if I had been, say, chair of the Fed or a top policymaker at the time, I probably would have been frozen with panic and done worse than what actually happened. So I'm not going to fault the Fed for not getting everything right at 2 a.m. in the middle of a crisis. What I do find fault with is that they've had 10 years to give an accurate account of what happened, and they haven't done that.
Yeah, they certainly haven't. When you come back, I want to talk to you a little bit. We need to take a commercial break. When we come back, I want to talk to you a little bit about what we've done now to prevent that from happening in the future, and maybe a little bit about also what investors could do to help prevent that in the future, to help protect themselves, because it's certainly an issue. And I appreciate your honesty. I know our viewers respect that when you say hindsight's part of that decision. So Lawrence, stay with us. We'll be right back. And you stay with us too. We'll talk to Lawrence Ball more about these types of financial failures and what we can do to protect ourselves moving forward. We'll be right back on The Income Generation. And we're back with Lawrence Ball, author of the book, The Fed and Lehman Brothers, Setting the Record Straight on Financial Disaster. So, Lawrence, as you know, our audience are members of the income generation, those over the age of 50, who, really can't afford to make mistakes with their money at this stage of their lives. The same generation in which you and I are, right? So do they have to worry about this in the future, or do you think the Fed is taking steps to prevent this type of disaster or domino effect from occurring moving forward?
I think people do have to worry about it in the future. I think we can hope that the Fed takes the lessons of the last episode to heart. And I think a key lesson being that they should be ready to prevent catastrophic failures of financial institutions with emergency loans. The problem there is that legislation since the crisis has put restrictions on the Fed's lending ability. That was part of the Dodd-Frank Act. So there's some question about how effectively the Fed will be able to deal with these crises in the future. I mean, as far as what people can do about it, I don't really have much to say other than hold a diversified portfolio and hope for the best.
Well, how about this? For example, there are the list of the financially systemic companies that are too big to fail and those that are not. So maybe by sticking with the companies on those lists, maybe that might help a little bit?
I don't know. I think in the worst case in which the systemically important companies go down, they'll probably drag the rest of the economy with them. I don't think there's really, something, if there's another crisis and it's mishandled, that will badly damage the U.S. economy. And there's probably no way to protect oneself other than not investing in the U.S. But of course, other economies also may have crises. So unless there's a safe investment in Mars, I'm afraid I don't have any great advice.
So in the 45 seconds or so we have left, do you agree with our last guest who is worried about having pushed people up the risk curve with what the Federal Reserve has done in creating a stock market bubble, but also having created a kind of a worldwide debt bubble? Are those concerns of yours also?
Well, briefly, I would say not really, in the sense that the Fed's policy has been necessary to help the economy recover from the Great Recession. And a healthy economy is the number one thing for not only employment, but also returns on savings.
Okay. All right. So in 15 seconds or less, tell us, what is it you want people to get from reading your book?
To get the idea that you can't take at face value everything the government officials say. That's not a new insight, but it was driven home to me that we have to be very critical of the official account of the crisis.
Yeah, those are great words of wisdom. Lawrence, thanks so much for being on our show today. It's been a pleasure.
Thank you very much.
And stay with us. We'll be right back to wrap up this week's episode of The Income Generation. Stay with us. I'd like to thank both of our guests for joining us for another episode of The Income Generation. I'd also like to thank you, our new and returning viewers. Yeah, man, what a long, strange trip it has been. It started 10 years ago with the subprime mortgage crisis and continued with the collapse of the housing market and the federal bailout of the banks responsible. It then continued through not one, not two, not three, but essentially 4 rounds of quantitative easing. After 95 years of responding to financial crises, the Fed completely threw out its playbook in 2008. It forged ahead with elaborate artificial stimulus efforts despite their diminishing impact and with little regard for their potential long-term consequences. Even worse, other central banks around the world then followed our bad example, together creating a global economy steeped in artificiality, dependent upon cheap money and drowning in debt. And where does all that leave us today? Well, we're still on this long, strange trip, unfortunately, and no one knows for sure how, when, or where it's going to end. No one knows because so much of what's happened in the last 10 years has been completely unprecedented. Even under normal circumstances, trying to forecast the direction of the economy and financial markets is extremely challenging. In today's all-new age of economic uncertainty, it's much, much more so. But even as this trip continues, there are still some things that you can be sure of, and the most important to remember is this. Yes, it is possible to significantly reduce your investment risk. How? By shifting your strategic focus from portfolio growth to retirement income. Yes, it's true that the repercussions of all the Fed's experimenting these last 10 years are likely to impact every corner of the markets before they can make fundamental sense again. However, that impact is also likely to be stronger and potentially much more damaging in some corners than in others. The point is this: pick the right corner now, the safest, most conservative corner. Thanks for watching. Bottom line is, if you're close to retirement or currently retired and you really want to know how to protect and maximize your money, it's absolutely essential that you stay informed and keep up to date. And right here is where you can do it with me on the Income Generation. I'm David Scranton. Thanks again, and we look forward to seeing you next week.